traded funds, ETFs versus mutual funds. Understanding the difference. Hey everyone, welcome back. In today's video, we are going to break down the difference between exchange traded funds or ETFs and mutual funds. Both are amongst the popular investment options, but they work a bit differently. Let's understand the key differences so you can make a more informed decision for your portfolio. What are ETFs? First, let's talk about ETFs. An exchange traded fund or ETF is a type of investment fund that's traded on a stock exchange, much like individual stocks. It holds a collection of assets like stocks, bonds or commodities and allows you to invest in a variety of assets with just one purchase. One of the standout features of ETFs is that they can be bought or sold throughout the trading day at market prices. This gives them flexibility, especially for active traders. The price of an ETF can fluctuate during the day based on supply and demand, just like stocks. What are mutual funds? Now, let's discuss mutual funds. A mutual fund is a pool of money collected from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. Unlike ETFs, mutual funds are not traded on exchanges during the day. Instead, they are priced at the end of the trading day based on the net asset value or NAV. When you invest in a mutual fund, you buy or sell shares at the NAV, which is calculated after the market closes. This means you won't know the exact price of your transaction until after the market has closed for the day. Key differences in trading. One major difference between ETFs and mutual funds is how they are traded. As mentioned, ETFs are traded on exchanges throughout the day, so you can buy and sell them whenever the market is open. On the other hand, mutual funds can only be bought or sold at the end of the trading day, once the NAV is calculated. ETFs also typically have lower expense ratios than mutual funds. Since ETFs often passively track an index, their management fees can be lower compared to actively managed mutual funds, which tend to have higher costs due to the involvement of fund managers. Liquidity and accessibility. Liquidity is another important difference. ETFs are generally more liquid because they trade like stocks, allowing you to enter or exit positions quickly. Mutual funds, while they provide diversification, may not be as liquid because you have to wait until the end of the trading day to execute your buy or sell order. Final thoughts. So, to sum up, ETFs and mutual funds are both suitable investment options, but they have key differences in terms of trading, costs, and liquidity. If you found this video helpful, don't forget to like, comment, and subscribe for more financial education. Thanks for watching. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.